Hey everybody, it's John King. It is Friday, the 1st of August, and it is an action-packed week, an action-packed morning. I got a lot to share with you, and I'm going to move through it pretty quickly. So first of all, it is deja vu all over. This feels exactly like we felt 1 year ago today. Now, you may not remember it, but I remember it vividly. And literally the 1st of August, and the Fed, we basically knew that the Fed was going to lower interest rates in September. The market fully expected rates to lower, and mortgage rates went down in anticipation. So we saw mortgage rates drop a year ago in August and the first half of September, waiting for the Fed to lower their rates. And then the moment the Fed lowered their rates, mortgage rates started shooting back up. And I feel like we're dealing with deja vu all over again. So I'm going to walk you through what happened this week and why I think that's exactly what we're about to have happen. Now, obviously, I'm predicting the future. Nobody can predict the future, but a lot of things sound like what happened in the past. So the first thing is gross domestic product. I mentioned it last week on Friday. We were going to get the GDP report on Wednesday of this week. What is GDP? It is the calculation of how much goods and services the U.S. economy produces. Well, in the first quarter of 2025, GDP was down. That's bad news for the economy, and it means that we're likely in a recession or headed into a recession. And had Wednesday's number also showed lower, then technically we would be officially in a recession. But Wednesday's number showed higher. It showed a lot of growth in the economy, which means we're not in a recession. But that may not actually be the truth. So here's what's really happening. The number in the first quarter was low because there were a lot of imports. And it's a weird calculation, so you're gonna have to follow me here. The more goods we import, that is a downward or negative pull on our gross domestic product, how much we made here. So in other words, if we're using a lot of stuff that we imported, then that means that the GDP is lower. If we're using or consuming goods that we created here in the United States or exporting a lot of stuff, then we produced a lot. And so they compare how much did we import compared to exports. And in the first quarter, we imported a lot more than we exported. But that was unique. That was a one-time thing. Why? Because of the trade wars. Because Trump had said in early February that he's going to implement across the board tariffs on April 1st. So for the first 3 months, between February and March in particular, a lot of people imported things ahead of time so they didn't have to pay the tariffs. That brought GDP down. Now, GDP is way up. Why? Because nobody's imported anywhere near as many things from overseas because of the tariffs. Because of the fear of tariffs, imports were way down in the second quarter, which made GDP shoot up. Neither of those numbers are correct, and so it's creating a mirage. It's creating an illusion, and it makes the markets not really know what direction to go. But the Fed said on Wednesday, hey, we're going to hold firm. We see GDP is strong. That means that the economy is strong. Well, is it really, or are you not reading really what's going on? Then the Fed says, look, employment is super strong. Like, we've got job numbers from the May report that came out in June, huge amount of job growth. The June report that came out in July, huge amount of job growth. The economy is strong, the Fed says. We're not going to lower interest rates. We're going to be in a wait and see approach. We are most focused on employment because we are worried about inflation, and we think that the tariffs that are coming into play are still going to lead to more inflation. And maybe they will. Maybe they won't. The Fed is guessing. But here's what they got wrong. They didn't know what was going to happen today with the jobs report. Because the jobs report today, major news, because not only were there a lot fewer jobs created this month, but there was a revision to the jobs that were created in May and in June. And so let me show you, or let me pull up here really quickly. So the May numbers were like 180,000 jobs created in May. They dropped that to 19,000 jobs. Huge drop. The June numbers said there were similar 160, 170,000 jobs. They dropped that to 14,000 jobs. And then this month, 73,000 jobs created compared to the expectation of 110. So what happens is every single month, I've talked about this before, every single month, the federal government calls halfway, 3/4 of the way through the month. So over the last 2 weeks, the Bureau of Labor and Statistics has been picking up the phone and calling companies and saying, hey, what is your job situation right now? How many jobs have you added or deleted in the last 30 days? And they use that statistical data of making a few phone calls to extrapolate out what does the job market look like. And then they get more data. So the calls that they made in May, they told us on June 6th what those results were. Well, then they get more data going forward. And so in July, they revise the report. So in July, they tell us June's headline number, but they revise May. And then in August, they tell us July's number, they revise June, and they revise May. Because over the 3 months after they do the initial report, they're gathering more data. They're finding out, well, what is really the job situation? And this is the largest revision we've had since the 70s, if you don't count COVID. Now, during COVID, they just were way off on the numbers. They were way off on job creation. They didn't realize the job losses right away like they really were. So COVID kind of was unique. But since COVID, this is the largest revision of the jobs numbers that we have seen since the 70s. This shouldn't be that hard. Now, I got a text. Yeah, Donald Trump texted me. I'm just kidding. I got a notification on my phone about a half hour ago that President Trump has fired the chairman of the Bureau of Labor and Statistics, chairman or committee chair. I don't know what the heck he is. Whoever's in charge of this department at the federal government, he's gone. Because this is astonishing that they would have that big of a revision. We have been making decisions. The Federal Reserve has been making decisions with the understanding that the jobs market is super strong and that everything is fine. And I've been talking for the last couple of months about what I'm hearing from my clients and what I'm hearing from industry people of saying, look, the jobs market doesn't feel as strong as the Fed is saying. And bam, we end up today getting the revision saying, you're right. So now the Fed, had they known this Wednesday, probably would have dropped interest rates. The probability of a 25.25% rate drop on the September Fed meeting prior to this morning was about 48%. As of this morning, it's jumped to around 90%. Like the markets are as sure can be that the Fed is going to lower interest rates starting in September. Well, that's exactly what happened a year ago. 1 year ago, we had exactly the same situation, and interest rates fell not because the Fed lowered interest rates, but because we thought the Fed was going to. Now, this is Okie Dokie says, seems like a cover-up to manipulate the markets. I don't know. I thought about that. I was telling my wife this morning, and she's like, how can they make that kind of a mistake? Like, that's got to be somebody playing with the numbers. I hear you. Like, I listen to my wife a little more than I listen to you. Hope you understand that. Anyway, the fact is, you're right. Like, this is crazy, which is why Trump got rid of him. Like, this is unacceptable for the United States in 2025 to not be able to get more accurate numbers and to make such a significant revision in the jobs numbers that is going to change the trajectory of how we're going to manage our monetary policy. So right now, we are in a sweet spot that I think is going to lead to lower interest rates. Now, all eyes right now are going to be on the CPI Consumer Price Index. That's inflation numbers for August. But more importantly, it's going to be on the jobs market. We knew inflation was coming down. It's been kind of teeter-tottering. The Fed says I'm worried about that. But the jobs market they thought was strong. So the biggest, most important day in the next 45 days is going to be the first Friday in September, because that is going to be confirming or reversing what we just learned this morning, which is, hey, are we in really deep trouble as far as the economy and the jobs situation, or were they wrong again about being wrong? Like, let's think about that for a second. They're saying today they were wrong in May and June on the reports that they came out with. And so in September, are they going to say they were wrong about being wrong, or are they going to confirm that they were right? Okay, so that's really what we're going to be paying attention to. I think we're going to see the likelihood of interest rates coming down over the next 6 weeks. Now, here's the problem. We thought the same thing last year. We thought, man, we are here. We've reached the Holy Land, the Promised Land, because the Fed is now going to start lowering interest rates. And everybody is thinking the same thing right now, is the Fed's going to get back on the bandwagon of lowering interest rates. But when they meet again, and maybe they do lower interest rates, but they're likely to temper our expectations. The expectation of the news is usually better than the news. There's an old adage in the stock market that says, buy the rumor, sell the fact. Because the rumor about what's going to happen often is better news than the fact. And that's led true last year when the Fed met in mid-September. They lowered rates by 0.5%. Mortgage rates went up. The best day to lock in interest rate in the last few years was September 14th. I believe it was the 15th that the Fed met. If I'm off by a day, forgive me. But the day before the Fed met was the absolute best day to lock in interest rate. Now, we got a lot of volatility in the next 6 weeks, but the trend says we're likely to see interest rates getting better. So my advice to everybody right now, if you are a homeowner and you've been on the cusp of saying, you know what, I think I should refinance, I think I should consolidate my debt, start now. Like, start right now. Maybe we lock your interest rate because we don't want to worry if it's going to get worse. Maybe we wait and hold things off until we get further into this month or even into early September. But I fear that the fact of what the Fed does in September is going to be less beneficial than the rumor that we're going to see in the meantime. So buy the rumor, sell the fact, lock your interest rate while it's rumor about what the Fed's going to do. Don't wait until it's fact, because the fact is rarely as good as what we would hoped it would be. So prepare now. If you're looking to buy a home, you need to get out and start shopping. And the challenge is, as a home buyer, you don't have the same flexibility as somebody refinancing, because once you get into contract, you have to close within a certain amount of time. We typically have to lock your interest rate at least 10 to 14 days before your close of escrow. So maybe you decide to risk it and float a little bit to see if things get better, but you don't want to risk it too long. And you don't want to wait and say, oh, I'll start writing offers on September 1st so I can lock in the first 2 weeks of September. Because if you don't get an offer accepted, you can't lock your interest rate. And if we repeat the pattern we had last year, you're going to regret it, because you're going to see higher interest rates after September 15th. I don't know that's the date the Fed is meeting, but it's around that date. We're going to see higher interest rates after that, is what the pattern was from last year. All right, so Okie Dokie says, what about when it comes to CalHFA? Will it also be the best day that they lower? So CalHFA's rates follow the same pattern as the market rates. It's based upon the market. So it's the same pattern. It's the same concept that I'm talking about here, where do I think rates are going to get better over the next 45 days? I do. Like, I honestly do, based upon the information that's come out this week. If you would have asked me that a week ago, I would have said, I don't really think it's going to happen. So the problem is, a week from now, I can change my opinion. It is the same as your stockbroker telling you, hey, you should buy this stock because I think it's going to do good. He's predicting the future. No matter how good we are at what we do, we're guessing. We are predicting the future. But if I were to predict the future for you right now, I believe that we're seeing a repeat of what we saw last year. We're going to see interest rates coming down between now and the middle of September. We're going to see your opportunity to lock in some of the best rates that we have seen all year are likely to be coming right now. Okay, so this is the moment when we've been waiting for. Now, again, can it come out different? Yes, it absolutely can. Anything can change. I thought last year that after the Fed had their announcement on September 15th, we were going to see rates continuing to trickle down. They didn't. They shot up because the Fed made it clear we're lowering rates, but we're not going to lower much at all anymore. And it was the truth. So I don't want to get ahead of ourselves, but we've got the perfect storm of a window of time, just like we had last year, where all of the data says the Fed was wrong 2 days ago. The Fed should have lowered interest rates 2 days ago, and they didn't. And the rumor that they're going to lower interest rates is often better news than the fact of when they lower them. I need to repeat again, the Federal Reserve does not control mortgage rates. The mortgage world is looking at the economy, it's looking at the bond market, it's looking at the stock market, it's trying to predict where the Fed is going, because the Fed, if you think about, I had a good analogy this morning. I was reading an article and they talked about basically it's the tail on a dog, and the Fed is the dog and mortgage rates are the end of the tail. Now you have other rates, you have your car loans and your credit card rates. Those are closer to the tail, closer to the dog. So they're on the tail, but they're closer to the dog. And so when the tail is wagging, or the dog moves one direction or another, like the ski boat pulling a skier, right? The shorter your rope, the more you turn with the ski boat. But if it's long rope, the further away you are, you're still tied to the direction the boat is going, but you're not turning as fast or as much in the direction that they are. You have more room to continue going the direction you were going. Mortgage rates have more separation, more room, because mortgages are typically 30-year loans that are more acting like 10-year debt, because mortgages never last 30 years. So you have to recognize the Fed does not control mortgage rates. Do not wait until the Fed lowers rates, because rarely, sometimes, but rarely does the Fed lowering rates actually cause mortgage rates to go down. We lower rates, I have no control over it. Mortgage rates go down in anticipation of what it thinks the Fed is going to do, and often they shoot up once the Fed actually does it. So that is my message for today. If you have any questions, feel free to post them. I know we have one more right here. Real quick, my podcast every Tuesday. If you want to listen, go to FromProfitsToProperties.com. I talked about business owners and how to just some coaching ideas and things you can do to build a stronger business, be more profitable. That's why you are in business. And then how to take those profits and turn them into long-term growth strategies. That is about buying investment properties, buying your first home, strategies on building wealth through real estate. So even if you're not self-employed or a business owner, you can skip the first half, although it's good information just for anybody who wants to get better at life skills. There's lots of life skill stuff I'm talking about. The first half of each podcast that are specifically focused on business owners, but the second part is great as far as growing a portfolio of real estate and learning how to develop your wealth through real estate. So make sure to check that out if you haven't already. So I'm going to shift to questions, then I'm going to bail out on you guys. So it looks like I've got one more thing. Okie dokie. Ooh, the home value. All right, here's the deal. We're definitely seeing more weakness in home values. Like we are for sure seeing more weakness in home values. This is a dangerous game of chicken. Now, some people are telling me, John, I'm worried, or asking me, John, I'm worried. Does this feel like what it felt like in 2007 as the market started to come down? The truth is it does feel like that, because I remember telling many of my clients in 2007, look, you're getting a deal compared to what houses were selling for 6 months ago. You need to jump on this opportunity. And that was true in the moment. And then we learned that it was going to get worse and that the market dropped even more. So in hindsight, I would have been better off giving the advice of saying, hey, wait a little bit longer because you're going to get a better deal. I have no idea if that's going to be the case, but I will tell you a couple of reasons why I still stand by the advice that says buy when you can, even if you think there's a chance prices are going to go lower. The two reasons. One, I have zero expectation that we're going to have a repeat of what we saw in 07 and 08. That was caused by the mortgage industry giving people loans that they could not actually afford to pay. So it was a house of cards that was built with no foundation. And once it started falling apart, the whole house fell down. You had people with adjustable rate mortgages that couldn't afford their payment. And when house prices dropped a little bit, they needed to refinance to get out of their adjustable rate mortgage, or their payment was going to go up higher. That's not going to happen this time. So that domino effect, the first people who lose their house because they lose a job, because they can't afford their monthly payment, that is happening right now, and that will happen some. You're also seeing sellers lower their prices just because they need to get the home sold. And so now you're going to have somebody who had a job transfer that needs to move, that just bought their house a year ago with zero down payment, that can't get out of the house, and they have to let it go. There's going to be some challenges. There already are happening, but it's not going to be systemic, because the next person in next door to whoever lost their home, has a fixed rate and a fixed monthly. So that's the first reason why I'm not worried about it being a major problem like we had in 2007, 2008. The second thing is, even during that era, prices continued to go down from 07 to 2011. We hit the bottom of the market in 2011, and we didn't know it was the bottom. I literally bought a home, what was it, October of 2011. And I was talking to my wife about, hey, maybe we should rent for a little while and wait longer. We sold one house and we were going to buy in another house, and we decided, I was advocating, gosh, prices have been dropping for the last 4 years, and I don't see an end in sight, because you don't see the end until you're past it. And so I was advocating, hey, we should just rent. My wife said, do you like being married? And I said, well, of course I do. And she said, great, then we're not renting, we're buying. It happened to be at the exact perfect time. But I couldn't see it. I couldn't see it because you can't see the market turning in front of you. So you have to buy because it's the right thing for your family. I am super glad I did it. I bought at the perfect time. And you know what? That doesn't make me smart. It makes me lucky. And you can't control luck. You buy because it's the right time for you to buy, not because it's the right time to time the market. And then the final thing is, even if I would have bought that house in 2008, just as the market was starting to come down, by 2015, 16, prices were back above that level. So we had the largest decrease in home values that we had seen in generations, and prices were back up a few years later. And that is the cycle. That's what we see. And so even if you buy a home today, and I understand Okie Dokie's concern, I understand that we have a chance for housing prices to go even lower than they are today. And I don't yet see the end of this. I see more now. When interest rates start really coming down, that's going to signal part of the end of this. Will that be the end? I don't know. But what I do know is right now we've got a lot of buyers sitting on the sidelines and they're waiting until interest rates are lower. And by that time, it's likely that all of their friends who are waiting to do the same thing are jumping back into the market. And so they're going to end up in a position where they're actually going to be buying at a higher price than they needed to versus those who bought now. As long as you can afford the payment and be aware of the fact that you have no guarantee of refinancing in the future. But when it does happen, you've got the lower price and you're able to refinance to get a lower interest rate and you've built equity in the property in the meantime. So I know that was a lot deeper of an answer to simply what I'm seeing in home prices. I am seeing them stagnate across the country. I am seeing some markets and some homes super fast moving, super aggressive. Other ones are not. But it's really about the home, not the market. Okay, so that's a really important thing. All right, I got to wrap up here in a minute. Interest rates came down after 08. Did people jump back in? So you couldn't jump back in. The difference in 08 is they couldn't jump back in because they were frozen out of the market. Because all of the there's a huge contingent of people that had a foreclosure or a short sale and they were in the penalty box and they couldn't jump back into the market. And you had a glut of homes that the bank owned that they were selling, and the bank didn't have an emotional tie to the home. The bank needed to get it sold. Right now, we don't have many bank-owned homes, and I don't expect to. And so when interest rates come, we've got a lot of sellers who have said, hey, I don't have to sell. Like, I'm living in the house. I'd like to move. I'd like a bigger home. I'd like a nicer home. I'd like a smaller home, whatever they would like. There isn't a have to. But when the bank foreclosed on the home in 07 and 08, they had to sell. And so we didn't see prices come back up right away, even when interest rates came down, because you had a huge segment of the buyer population that was locked out of the market. And then you had a huge supply, everything's supply and demand. You had a huge supply of homes because the banks can't hold on to them until the right time. Investors, they're earning rental income. The bank can't rent out the home. So even investors who are saying, hey, the market's dropped some investors will liquidate and say, I'm out. But some investors are like, what the heck? I'm still making good rent. I've still got positive cash flow. I'm not pulling out. And so you don't have to sell. An owner occupant doesn't have to sell unless he's got a job transfer or a job loss, an income loss, and he can't afford the monthly payment. And even in that situation, sometimes they can just convert it to a rental. Equity is at all-time highs right now. So people are not walking away from homes compared to 07, when you had people buying for the last 5 years, a huge number of homes with zero down payment, and a majority of them had adjustable rates with very little equity. We have the exact opposite now. We have a majority of the homeowners with significant equity and fixed rates. There are some people that bought in the last few years that have no equity. There are some of those people that are going to lose a job or have a job transfer, and they're going to lose their home. And I don't say that without care or concern. I'm saying it factually, but that's not an epidemic like what we saw in 07 and 08. All right. You're welcome. I appreciate my lives very much too. Guys, I'm going to bail. I've got an appointment at 1 o'clock. Hope everybody has an absolutely wonderful weekend. We'll talk to you next week. And as always, I'm interviewing to be your lender. If you want my help, please scan that QR code above, schedule an appointment with me, and I will take great care of you. Have a wonderful weekend, and we'll talk to y'all soon. Bye-bye.